Hello, friends. I've received a lot of requests from my online family about making a video or some amount of clarification about the SEBI rules that were announced on the futures and options derivative lot size. Well, if you remember, I have made a couple of videos in the past about what happens if the lot sizes are increased, your strategies, and what if the margins are increased, how much capital would be required to trade under those changed circumstances. Now, this video, or rather a podcast, is important not just from the point of view of analyzing what SEBI announced in these new regulations, but what I find noteworthy is also noting what they did not specifically mention. Now, that makes this video a lot more interesting, a lot more relevant, and I think you should pay attention to what is being discussed here. In the new derivative framework, in furtherance to the 30th of July 2024 Secondary Market Advisory Committee or SMAC, the consultation paper that the expert working group issued guidelines on 1st of October were as under. Now, clause number 5.1.1 in that report says that all brokers will basically be required to collect option premium from option buyers upfront. Well, in my humble opinion, this does not change anything at all. If you have been buying options, your broker invariably charges you the premium and issues the end of the day bill to you with the premium collected upfront. So this is not likely to change your capital intensivity or the amount of capital that you're required to invest in the derivative segment. Now, clause number 5.1.2, it says the brokers will be required to collect initial, which is the span margin, and ELM, which is the extreme loss margin, upfront from traders, even if the trader has chosen to trade intraday only in the leverage segment. You know, some brokers offer you a lot of margin trading facilities, MTF, where the leverage is higher. The only thing is your trade will be automatically closed by 3 or 3:15 depending on the broker's software without you having to do anything at all. You're not allowed to roll over that trade to the next trading session. So even if you're a margin funded trader and you're doing this trade only for an intraday basis strictly, your ELM or extreme loss margin along with span will still have to be paid, which means the amount of leverage that you're enjoying, the extra amount of leverage that you're enjoying, will be gone. Now, this will come into effect from 1st of February 2025. So we still have time, but the clock is definitely ticking. Now, clause number 5.2.1 is pertaining to the treatment offered to calendar spreads. Now, friends, what are calendar spreads? Now, calendar spread is an ideal kind of a strategy where you are trying to basically collect premium from either options or from futures or even both. If you've noticed, in a normal market, when the cost of carry or the financing cost or the rollover cost is positive, which means the current month future is say approximately 100 rupees and the next month future is trading at 102 rupees. Your cost of carry or your rollover cost in that case is 2 rupees. So what many traders do who are not actually interested in taking risk or a direction trade, they will buy the current month future and sell the next month future. Why do they do that? Because towards expiry of the current month futures, the price of the current month future will start converging towards the spot price because the premium will erode over time. And the next month future which they have shorted, that premium will also erode because some passage of time would have occurred. In that case, they square up the mid-month, which has now become the first month after expiry, and they short the next month because that will be trading higher. This system is called calendar spreads. It is basically for financiers, interest rate sensitive traders who are not taking a risk. Remember, you are long in one series and short in the other. So direction wise, your delta is covered. Since it's a delta neutral strategy, the exchanges tell you, hey, we don't think you're posing any risk of default to us. So we will collect a very small token amount of margin from one of these two contracts that you are trading, and the discounted margin is collected from the contract which attracts a smaller margin of the two contracts. Now, this is an advantage that calendar spread traders actually have over routine traders, because the margin required is absolutely lower compared to a regular trader. Remember, he is not taking a directional call. He's long and short. Now, under the new guidelines, clause 5.2.1, on the expiry day, only on the expiry day, this calendar spread cross margining facility will be removed, which means you will be required to pay margin on both legs of the trade, long and short, no discount. In my opinion, the amount of money that you require to basically earn interest by way of calendar spread strategies has gone up. It won't double, but it'll probably go up to 1.5 or 1.75 times more than what you're doing now. What if basically you are doing calendar spreads in three series, which is mid month, current month, and the far month? In that case, the discount offered on the first month series will be removed. The discount on the second and third month will still remain. However, extreme loss margin, which is the worst case scenario in case the stock falls, will still be levied, which means another set of investment in capital will be required. That means your capital outlay is definitely going to go up further. Now, clause number 5.2.4 mentions that it will be applicable from 1st of February for 2025 year onwards. It says that the law which is coming into the regulation which is coming into place for calendar spreads will be for index derivatives. Now there I'm slightly confused and I'm also hopeful, which I think even you would be. The very fact that this PDF file, which is a 8-pager, mentions index derivatives, I hope that SEBI says, look guys, we are not going to touch the stock futures and options. Because if you've seen when I upload my daily post-market summation note, the turnover actually comes from the options segment, and that too, the index options command the lion's share. Now, this breakup is something I give you in the retail risk appetite in our weekly market outlook videos. So what SEBI is doing, in my humble opinion, is targeting the index derivatives rather than the stock derivatives. I just hope I'm not wrong in raising hopes of both myself and my online family, but I think this means that stock derivatives are not included in this. Now, clause number 5.3.1. Even intraday positions will be liable for paying margins, and these intraday positions will be monitored 4 times every session, which means the margin funding traders who are borrowing money from the broker, and instead of the usual 6 to 8 times leverage, they are enjoying up to 20 times leverage, etc. That is history when the regulation comes into effect. I will discuss the timetable of which law will come into what date. But what it simply means is you will have to foot up all the money that is required by the exchange if you want to trade. There will be no extra leverage allowed to you under any circumstances. Now, clause number 5.4, and this is important. It says that index derivatives, now this is specifically mentioned, which is again raising hope in my heart, that index derivatives which are currently off the market lot trading between 5 to 10 lakh rupees in value will now be raised as of 20th of November 2024, so that the contract size of the index will be between 15 to 20 lakhs, 1.5 to 2 million rupees. Now, here again, I just hope my reading is correct, but stock derivatives are not included. This does raise some amount of hope in me. Like I said, this regulation comes into effect on 20th of November. Now, clause number 5.5.1. To curb the excessive volatility in deeply out of money, very low priced index options on expiry day, and the word index is again specifically mentioned, which is good. On expiry day, it is decided to limit the index expiries to one index expiring every week per exchange. What is happening is that every day of the week is witnessing some index or the other expiring, weekly index expiring on every single day of the week. That will be curbed with effect after 20th November 2024. Every exchange will have to notify to SEBI which particular index they want for a weekly expiry, and they can offer weekly expiry only in that one particular index of their choice. So weekly expiry is now only once. Clause number 5.6.1. I always talk about hedging yourself from excessive volatility by tail risk or hacienda hedges. I think SEBI has been watching my videos. Oh, that's a joke here, but I'm very happy that somebody out there is also thinking along the same lines that I think and has talked about tail risk hedges. Now, since many months, there has been excessive threat of loss on expiry days, which is why SEBI has decided that a 2% extreme loss margin will be charged on short option contracts. Now, what is short option contract? Short option means options that you have sold. This is for option writers. Now, this regulation will include positions that you are bringing forward from the previous derivative cycle and the previous trading session, as well as the trades that you initiate on the expiry day itself. So for that one particular day on expiry, you will basically be required to foot up a lot of margins. Do remember, extreme loss margin on futures, extreme loss margin on options that you have written, and deeply out of money options, no calendar spread discounts on their expiry days. So on expiry day, my friends, do remember, you should have a lot of money in your brokerage account to fund all your trades. Now, this regulation on all options writing done on expiry day being charged with 2% extreme loss margin will come into effect from 20th of November 2024. Now, friends, I want to discuss with you what is unwritten in the SEBI norms. And before I do that, let me sum up the dates on which what regulation comes into effect. Now, the contract size for index derivatives, weekly expiry of only one index per exchange, tail risk hedge on options on expiry day, these three regulations come into effect on 20th of November 2024. Now, upfront collection of options premium from buyers, removal of discount on calendar spread on expiry days will come into effect on 1st of February 2025. Now, 4 times per day intraday monitoring of market-wide position limits will come into effect from 1st of April 2025. Now, friends, I come to what SEBI did not say. Now, here in clause number 5.4.1, I already mentioned, they have explicitly written about index derivatives. Now, I would love to have a clarification from SEBI that are stock derivatives exempt from here. Unfortunately, after scanning through a lot of newspaper websites and reports and analysis, I have not found this aspect being answered very, very clearly. So I think we'll have to wait for a couple of hours or couple of days maybe to get ample clarity. If at all stock futures and options are not being touched, hey, that's a celebration itself. Now, I'm coming to the crux of what my thing about what SEBI did not say was. Friends, you remember on 23rd of September 2024, SEBI made some startling disclosures, and don't worry about it. The hyperlink to this SEBI report is in the description below this video as well as in the pinned comment below this video. Now, SEBI made some startling disclosures which says that 93% of traders were losing money in FNO. And what is not really all that startling is I'm not talking about the ratio of male versus female traders losing their money. Although the numbers of both kind of traders losing money is intolerably high, this must come down. But the noteworthy aspect that you should remember is that the losing percentage in traders who were elderly, which means 50, 55, and 60 and above, was noticeably lower. If the younger traders were losing money to the extent of 93% of all traders, the older traders, only 79% of them were losing money. Although 79%, I admit, is very high, but see the remarkable difference between 79 and 93. And the good news is yet to come. Now that tells you that experience has a very good weightage of your probability of succeeding in the stock market. I'm thinking of recording a special video on how long it takes a trader to become proficient, profitable, and be capable of running your household expense, everything from electricity to your grocery bills and keeping a domestic help in the house, paying your children's school fees, etc., from pure trading income alone. It'll all depend on the feedback that I receive from you in the comment segment. So please do let me know whether you want that video. I'm coming to the heart of the matter. The highest losses were incurred by traders with an annual income of less than 5 lakh rupees. This reiterates what I said in my earlier video about how much money you need to be having before you think of becoming a full-time trader who depends only on trading income for running your house. Do notice the hyperlink to that video and all other videos that I want you to watch, as a matter of fact, which are connected to this particular video, are in the pinned comment below and in the description below this video itself. Now, coming to page number 24 and 25 of the SEBI report of 23rd of September, hyperlink is below this video itself. It clearly says that very high income earning category traders are people who are disclosing income in their annual tax returns in excess of 1 crore per annum. These were the guys who took away the lion's share of the profits. Now, before you start thinking that the market is biased or whatever, let me just offer my 2 bits as to why I think it's happening. Number one, like I said in that video, your confidence levels are extremely high when your account is deeply and very well funded. The mental peace that you have that you can hold your trade and stand your ground, and the conviction level that you have when there's surplus money backing up your trade is irreplaceable. So your conviction levels tend to be higher. Banish the thought that you can come to the market with a few thousand rupees and become a full-time professional trader who can meet all his household and living expenses from trading income alone. Our elders have often told us the old saying that it takes money to make money, and money attracts more money. Well, in the stock market, that's very, very true. I don't mean to mean any offense to any trader who does not have ample amounts of money to the extent that I have mentioned in my video as to how much capital you need to trade. No offense meant here. But if you're aiming to run your house on pure trading income alone, just be reasonable and calculate what is the percentage return that you will be able to garner every month, and then do the reverse engineering and see if the percentage return on the capital that you need to earn, say, 1 lakh rupees in a metropolitan city. If you're a family of 4, your minimum expense has to be 1 lakh rupees approximately. To earn 1 lakh rupees a month at the rate of return that you expect, be realistic, please. How much is the capital you would need? Is what SEBI has realized, and that's what the SEBI has said it in the report without actually emphasizing on it, and therefore I'm doing that for you. This is what SEBI left unsaid. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Let me know what you think of this video in the comments segment and what you'd want me to record in my next videos to help you understand the market better. A humble request, please share this video with your family and friends and all your social media groups to help me reach out to a wider audience and help them trade better. I wish you have a very, very profitable day. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye. Thank you.